Welcome to the deep dive. You, our learner, have given us some really fascinating materials today, focusing on something, well, absolutely essential if you're serious about the markets.
Yeah, developing your own trading system.
Exactly. We're going to step away from the noise, the gurus, all that, and really extract the core principles from these sources to give you a genuine edge.
That's the plan. We've been digging into excerpts from Van K. Tharp's Tenor Exito in Trading, Success in Trading, and our mission today isn't just to summarize.
Right.
We want to really dissect the steps for building a system, look at those tricky ways our own psychology can mess things up.
Oh, the biases.
Exactly, the biases. And also highlight why just focusing on when to get in, well, it misses so much of the actual picture.
Yeah, I think some assumptions might get challenged today.
Definitely prepare for that.
Okay, so Tharp kicks off with a 12-step process for system development. Let's start with step 1. Make an inventory. Sounds a bit basic.
It does sound basic, but it's really about radical self-awareness right from the get-go.
So not just listing your software or capital.
No, that's part of it. Sure, know your knowledge, your capital, your tools, but it's also about being brutally honest about your skills, your actual comfort level with risk, and maybe most importantly, the time you can realistically commit, you know?
Yeah, you can't build a system that fits if you don't know what you're working with, including yourself.
Spot on, like trying to bake a cake without checking if you have eggs.
Right. Okay, step 2. Open mind and market information. We all like to think we're open-minded.
Yeah, but are we? This is where those biases we mentioned really start creeping in.
So how does it apply to market data specifically?
Tharp really emphasizes collecting data without bias, which is, frankly, really hard. We naturally look for stuff that confirms what we already think.
Confirmation bias.
Totally.
Yeah.
So this step is about actively fighting that. Look at a wide range of info. Don't filter it based on your hunches. He says something powerful, that our facts are often just beliefs we find useful.
Useful beliefs. I like that. Okay, step 3 is determine objectives. Obvious, right? Just make money.
Well, yes and no. It's deeper. Your system needs to be a tool for specific, clearly defined goals, not just vague make money.
Like the examples he gives, Basso versus Gallagher.
Exactly. Tom Basso, managing his own money and business, has different goals than Gallagher managing client funds. Their systems must be different.
So what am I aiming for? Income? Growth? What returns are realistic?
And crucially, how much pain can you take? Your tolerance for drawdowns, because even a good system, a great system, will have losing streaks just due to random market noise. You got to be ready.
That's a critical dose of reality. Okay, number 4, time frame. How does picking, say, daily charts versus minute charts change things?
Oh, massively. It's tied directly to your life, your available time. Back to Basso trading is his full-time job.
Right, he can watch screens all day.
But if you have another demanding job, you simply can't run a system needing constant intraday focus. Your time frame, minutes, hours, days, weeks, dictates trade frequency, the analysis you use, everything.
Makes sense. A swing trader's life is very different from a scalper's.
Okay, step 5. Identify historical best moves in that time frame and find commonalities. How do you even start that?
Think like a market historian almost. Pick your time frame, pick your markets, and then hunt down, say, 50 to 100 really significant past moves. Big ups, big downs.
And look for clues beforehand.
Exactly. What recurring patterns or characteristics showed up before those big moves happened? Tharp suggests looking at work like William O'Neill's for stock patterns, for instance. Like, maybe strong trends often follow volume spikes after a consolidation.
Finding the fingerprints. Okay, step 6. Define the underlying concepts and objective measurements. So turning those observations into actual rules.
Precisely. This is where intuition becomes concrete. You need to say why you think those moves happened. But more importantly, define it all in ways you can objectively measure.
No fuzzy logic.
None. If it's a breakout, what is a breakout? Price moves X% above resistance. Volume increases Y%. It has to be black and white, quantifiable. Got it. Step 7. Add stops and transaction costs. Risk management and those sneaky fees.
Absolutely critical. Stops are your shield. They protect your capital. And they should logically flow from your entry reason. If price hits this level, my original idea is probably wrong.
Yeah. So the stop isn't just random.
It shouldn't be. And transaction cost commissions, Slippage Tharp calls them insidious. They nibble away constantly. You have to factor them in. A system might look great on paper,
But gets eaten alive by costs if it trades too much.
yeah, especially high-frequency systems.
Okay, step 8. Profit taking, exits, and expectancy. So when do we cash in? And how do we know if the whole system is even worth it?
Just as vital as stops, how do you get out when you're winning? Fixed target, time-based, trailing stop. Once you have rules for both exits, loss, and profit, then you can calculate expectancy.
Expectancy, the long-term edge, right?
Exactly. Is it positive? If yes, over many trades, you should statistically come out ahead, even with losses. Remember that simple example. 40% win rate, win $200, lose $100.
Let's see. 0.4200 is $80. 0.6100 is negative $60. So $20 profit per trade on average.
Boom. That's positive expectancy. That's your edge.
Cool. Step 9 is about high profitability trades. What makes these special? Just bigger wins.
Kind of, yeah. They're the trades with potential for much bigger gains than usual. The outliers. Often happens when the market really moves strongly your way.
The home runs.
Pretty much. Identifying conditions for these and having a plan to maximize them, like maybe using a trailing stop effectively, can seriously juice your overall results.
Makes sense to try and capture those big moves when they happen. Step 10, position sizing optimization. This sounds important.
Tharp argues this is maybe the most critical piece and the one most often ignored or done badly.
Really? More than entry or exit?
That's his argument. It's about how much capital you risk on each trade. He uses this analogy, throwing 10,000 golf balls at a wall.
Okay.
Each ball does tiny damage, but 10,000 of them. Huge impact. Same with losses. Small losses per trade can still ruin you if your position size is way too big.
Ah, so it's the cumulative effect.
Exactly. Correct sizing lets your positive expectancy work its magic over time without you blowing up your account on a bad streak.
That 10,000 balls thing really paints a picture. Wow. Okay, step 11, system improvement. So systems aren't static.
Absolutely not. Markets change, evolve. Your system probably needs to as well. This step is about constantly monitoring, analyzing performance.
Looking for weak spots.
Yeah, or ways to refine rules, adjust parameters maybe. It's about being proactive, analytical, always looking to get better, not just setting and forgetting.
Constant refinement. And finally, step 12, worst case scenario planning. Doesn't sound like fun.
No, but vital because it's uncomfortable. It's about mentally prepping for the inevitable losing streaks, the big drawdowns your system will likely have.
Visualizing the pain.
Sort of.
Oh.
Visualizing it and planning how you'll react, so you don't panic and make stupid, fear-driven mistakes when things get rough. Because they will get rough sometimes.
That whole 12-step framework feels really solid, actually. Comprehensive.
It is. It covers a lot of ground.
Now, let's shift gears slightly to Tharp's idea of the Holy Grail in self-knowledge. Everyone's looking for that magic bullet in trading.
Yeah, the secret formula myth is huge, but Tharp just dismantles it. He says the real Holy Grail isn't some indicator or secret sauce.
Yeah.
It's self-discovery. Understanding your own mind, your psychology, your biases, how you react when the market gets crazy.
Ah, so it connects back to his preface about governing your own life. It's internal.
Precisely. Success isn't finding the perfect system out there, it's perfecting the system in here.
Yeah.
He warns against chasing gurus or always needing someone else's opinion.
Like asking your neighbor for stock tips.
Right. He points that out, how people seek advice from anywhere. Real success, he argues, comes from independent thought and building a method that fits your psychology, your risk tolerance.
It's not just about being right, it's about managing yourself.
Managing losses, letting winners run, and that takes deep self-awareness.
Okay, let's dig into some of the specific psychological biases Tharp says affect system development. First one, bias of representation. What's the trap here?
It's mistaking the map for the territory, essentially. Thinking a simple chart like a daily bar is the market.
But it's not.
Not even close. A daily bar shows open, high, low, close. That's it. It misses all the emotion, the order flow, the why behind the moves. It's a tiny, limited snapshot.
And we make decisions based just on that snapshot.
Way too often, yeah. As if it's the whole reality. It's like you said earlier, judging a movie by one frame.
Gotcha. Okay, next bias. Bias of reliability.
This is assuming your historical data is perfect, which it often isn't.
Like errors in the data feed.
Exactly. Tharp mentions Chuck Branscombe finding his software used wrong price data, leading to bad signals. You have to question your data. Don't just blindly trust it for backtesting or trading. Small errors can wreck a system.
Ouch. A good reminder. Then there's the lotto bias. This one feels relatable.
Yeah. It's focusing only on those huge potential jackpot wins and ignoring or downplaying the much more likely small losses.
Chasing the big one.
Right, like that presenter Tharp mentions, only showing entry signals during a trend because that's the exciting bit the audience wants. It makes you neglect risk management, the statistical reality.
Ignoring the probable to focus on the possible but unlikely. Tharp's client thought it might be a defense mechanism.
Yeah, against feeling like you lack control. Interesting thought.
Okay, next is the need to understand bias. Sounds kind of meta.
It is a bit. It's our drive to create complex theories to explain why the market moves, even if the theories are built on shaky ground or, massaged data.
Like Elliott waves.
Tharp questions the basis for things like Elliott waves. Why should the market follow that specific pattern? It comes from our deep need for order, for predictability, even if we have to invent it sometimes.
Trying to force patterns onto chaos. Then the seduction of software. Backtesting.
Yes. Modern software makes it so easy to test countless strategies and find ones that look amazing on past data.
Creating a false sense of inevitability.
Exactly. An illusion of predictability. But those results are often curve-fitted, optimized just for that specific past data. They might completely fall apart in live trading or different conditions.
So past performance, especially optimized past performance,
is definitely no guarantee of future results. Big trap.
Okay, a huge one next. Aversion to taking losses. This feels like the core of so much trading pain.
It's incredibly powerful psychologically. Tharp references that classic study. Guarantee a $9 Gogar loss, or take a 95% chance of losing $10 and 5% chance of losing nothing.
And people took the gamble.
80% took the gamble, even though the expected loss was higher. We just hate locking in a loss.
So traders hold on to losers way too long, hoping.
Yep. Instead of cutting them quickly, which is like Trading 101, it's probably a primary reason why so many beginners fail. They just can't pull the trigger on a losing trade.
That study is chilling, actually. Shows how irrational we can be. Next, bias of conservatism.
This is when you find a pattern that seems to work based on a few examples.
And then you cling to it.
You cling to it and actively ignore or dismiss any evidence that suggests it stopped working or wasn't that great to begin with. You resist changing even when the market signals you should.
Digging your heels in. Lastly, the bias of randomness. Isn't the market somewhat random?
Well, it has random elements, but this bias is the incorrect idea that it's purely random and therefore you can easily exploit it by picking tops and bottoms.
Why is that wrong?
Tharp points out market distributions have long tails, meaning extreme, unexpected moves happen more often than in pure randomness. Also, even in truly random data, you get streaks that look like patterns but aren't.
So trying to perfectly time the highs and lows
is a loser's game, statistically speaking. Very low probability of doing it consistently.
Okay, that tour through the biases is illuminating and slightly terrifying.
Forewarned is forearmed. Right. Understanding them is the first step.
Definitely. Let's pivot now to time frame and market selection. We touched on time frame, but market selection.
Right. Time frame has to match your life. For markets, Tharp says consider, liquidity, can you get in and out easily without moving the price against you?
Crucial.
Transaction costs again. Volatility, does the market move enough or too much for your style? And does it fit your criteria? Are you looking for trends? Seasonality.
So choosing the right playground is key. And he mentions Ed Seikoda's approach to trends.
Yeah, the visual test. Stand back from a long-term chart. Across the room, can you clearly see the main trend?
If it jumps out at you, even from far away.
It suggests a powerful underlying force. Trading with that dominant trend generally improves your odds significantly.
Simple but effective. Look at the big picture. Now let's hit that common obsession. Beyond entry signals.
Yeah.
Why do people get so fixated on the perfect entry?
It's understandable. It feels like the most active decision. But Tharp really pushes back against this focus.
The high win rate isn't everything.
Exactly. You can win 80% of your trades and still lose money if those 20% losses are huge. What really matters for long-term success, he argues, are your exit stops and profit targets and your position sizing.
And you don't even have a system
until you know your exit plan at the time you enter the trade. It has to be defined up front, not decided on the fly based on fear or greed.
That's a fundamental point. Okay, so let's talk types of stops. What kinds are there?
He covers a few. Basic protection stops or disaster stops. Their only job is capital preservation if things go horribly wrong.
The emergency brake.
Right. Then there's maximum adverse exposure, or MAE. That's how far a trade goes against you before eventually becoming a winner or hitting its final stop loss.
What does MAE tell you?
It helps you see how much heat your winning trades usually take. You can use that data to potentially optimize where you place your initial stop. Maybe you're setting it too tight.
Interesting. What else?
Channel stops, moving average stops, these can often double as exits and profit-taking mechanisms. Trailing stops, percentage retracement stops designed to let winners run while locking in profits.
Like adjusting the stop upwards as the price moves in your favor.
Exactly. Volatility-based trailing stops are a good example, adjusting to how much the market is bouncing around. He warns against purely psychological stops, though.
Why? Too subjective.
Can be, yeah. Especially for long-term trend followers, you might get scared out too early. And he strongly advises against averaging down into losers or scaling out of losing position.
Because that violates cut losses short.
Directly. You're adding to a losing proposition.
Choosing the right stop seems like a science in itself.
Yeah.
Okay, expectancy and opportunity. With expectancy, what's the opportunity factor?
It's simply how often your system actually gives you a valid trade signal.
The frequency of trades.
Right. Think of two games. Game A has okay expectancy per play, but you can play it 100 times a day. Game B has amazing expectancy per play, but you only get to play it twice a week.
Game A might actually make you more money overall, even with a lower per trade profit.
That's the idea. You need both decent expectancy and enough opportunities to let that expectancy work. And again, high win rate doesn't equal positive expectancy if the losses are killers.
Got it. It's the combo of edge and frequency. Which brings us back again to position sizing is the key. Tharp really emphasizes this.
He hammers it, calls it the place where the secret of any trading Holy Grail lies. It's that central to him.
Wow. So what are the basic ideas?
Well, things like fixed fractional sizing, risking the same percentage of your capital, say 1% or 2%, on every single trade. The main thing is keeping the size small enough.
Small enough to survive the losing streaks.
Exactly. Small enough so that even a string of losses, which will happen, doesn't wipe you out. It lets the system's long-term positive expectancy actually play out. You absolutely must consider the potential for consecutive losses when deciding how much to risk per trade.
Survive the storms to enjoy the sunshine. Makes sense. Trading isn't just numbers, though. The psychological cost.
Yeah, Tharp points out the emotional wear and tear. It's real, whether you trade every minute or only once a month.
Even long-term investors feel stress.
Oh, yeah.
Maybe not the same second-to-second stress, but the fear of missing out on huge gains or watching a position slowly bleed during a correction, it takes a toll. You have to manage that psychological side, too.
It's part of the whole package. Okay, finally, testing and data considerations. What should we watch out for?
Need reliable data, as we said. Be aware data can have errors. And be very wary of software that lets you over-optimize.
Curve fitting again.
Exactly.
Well,
Tweaking a system endlessly on past data until it looks perfect for that specific history, often just for one market. Those systems rarely hold up live or in different conditions.
because they didn't capture a real edge, just noise from the past.
Pretty much. So backtesting is a tool, but you need robust validation, maybe forward testing on unseen data, to have real confidence.
So past performance, especially if it looks too good to be true, probably is.
Good rule of thumb. Man, this has been incredibly rich. So many layers to building a system beyond just picking entries. Let's try to boil down the key takeaways.
Okay. I think the big picture is building a solid trading system needs that structured 12-step approach. It needs deep self-understanding, knowing your psychology, your biases. It needs rigorous risk management via stops, clear profit goals,
And the big one.
and crucially, intelligent position sizing. Don't get lost chasing the perfect entry. Your exits and how much you bet are way, way more critical for long-term survival and success.
Invaluable stuff.
Right.
Okay, learner, here's something to chew on from all this. Really think about that interplay, that dance between your specific psychological makeup and the kind of system that would actually work for you.
Yeah, are you prone to that lotto bias, chasing jackpots? Or does loss aversion paralyze you?
Knowing those tendencies, that's the first step, right?
Yeah.
To building something you can actually stick with when the market gets tough.
Absolutely. And maybe dig deeper. Check out the resources Tharp mentions: LeBeau and Lucas, Perry Kaufman O'Neill for more on system design, psychology.
And reflect on those 12 steps. Think about your own goals, your own limits. What's the one concrete thing you could do, maybe even today, to start moving towards a more systematic, more self-aware approach to your trading?
That's the challenge. It starts with that first step.
A great place to leave it. Thanks for joining us for this deep dive. We'll catch you on the next one.